Welcome back, dear students. In this presentation, we'll take a look at stock transactions and transaction costs and where to get some good information about stocks for free. Starting on slide 36, there are several types of market transactions, market orders, but we're only going to take a look at four, and really we only need to take a look at one, because in my humble opinion, the only one that really makes any sense to prudent long-term investors is the market order. You want to buy the stock, you buy it. You want to sell the stock, you sell it. You just take the current price that is being offered on the stock markets, depending on where the stock is selling. But there are others, like limit orders, which say, I want to buy the stock, it's selling for $25, but I don't want to spend $25. I'll put a limit order, which says if it hits 20 or 22, I'll set a limit order for $22. And that means I will not pay more than $22. Now I might pay less if the price plummets, but I'm not going to pay more than 22. Now, what's the problem with this? You might never get the stock, right? Because it might keep going up. Oh well. And the same thing is true on the sell side. It's selling for 25, but I don't want to sell at 25. I'll set a limit order for $28, so that if it ever goes above $28, I'll then sell. I'm going to get a better price. I'm going to get $28 or better than 28. Now, what's the stop loss, stop limit? Well, they're very subtle, the differences. But the stop loss order, sometimes called a stop, says, look, I want to buy the stock, I want to sell the stock, but only when this trigger price is reached, this trigger point. And then it becomes a market order. So, for example, I want to sell the stock. It's usually used when you're selling. It's selling for 25. I own it at 25, but if it ever goes below 22 or so, I want out of there. I want to sell. And so that's why it's sometimes called a stop loss order. A stop limit order is basically the same, but it becomes a limit order when it hits the trigger point. So you see the difference? The stop loss, it might fall from 25 to 17. You're gonna sell it at 17. The stop limit says, okay, it went down to 22. You're going to sell for at least 22. It's a limit on how much you will sell it for. Although you can, and if if they confuse you, stay away from them, because I don't think they're worth that. I mean, to me, if you want to buy the stock, buy it. If you want to sell the stock, sell it. I mean, it's that simple. But although you can use limit orders to buy or sell at the price you want, and stop loss and stop limit orders to lock in profits or protect against losses, remember that they trigger automatically. It's all electronic. The people on the floor used to write it down in a book. That, oh my goodness, this guy wants to buy if it ever hits this. It's not, they don't write it in a book anymore. It's all electronic. If for some reason you change your mind, it's too late, folks. It's already been executed. By the time you get to the computer or call your broker or tap on your phone, it's too late. The transaction has already been initiated. And so here's a little table that you can, try to internalize if you're going to be a short-term trader, because short-term traders tell me that they prefer to always use stop orders, stop loss orders, stop limit orders on their trades. So there you go. You decide. You want to buy it, buy it. You want to sell it, sell it. That's a market order. The subtle differences between the other three, do your best, and maybe going to ask you on the exam. But more importantly, if you're a prudent long-term investor, if you're a prudent long-term investor, you don't care. You're going to buy the stock, you're going to sell the stock, and that's all you have to worry about. Now, let's take a look at transaction costs. Well, you know what? They used to be a lot higher. transaction costs were in the 1 to 5% range. The largest portion was the brokerage commission. Well, technology has driven the commissions down to $7, $5 a trade. And then there were two other companies that started offering free trades, but they didn't. One disappeared, the other one turned around and started charging again. But this one company that I'm sure you've heard of, especially if you're younger, is Robinhood. They have been able to turn it into a profitable business by offering free trades. And now other brokerage firms have said, oh, damn, we have to follow their lead. But have transaction costs really gone down? Oh, yes. Oh, yes. Oh, yes. Technology has pushed the cost of transactions far lower than it used to be. But more and more of the cost, in fact, all the cost for you folks who are using Robinhood and other brokerage firms that don't charge a commission, the costs are being hidden from you now. Come on, you don't really believe that your transaction costs are zero, right? Doesn't that sound too good to be true? I mean, why would a company build this huge network and advertise and have hundreds or thousands of employees and then sell their service for free? Nah, okay. Here is an example. A deep discount internet broker offers trades for $7. In the fine print of the client-broker agreement is included a provision for allowing the broker to solely utilize exclusive stock dealers, market makers. Remember them from the previous presentation? They buy and sell stocks out of their own inventory. They make money off the spread, whereas a broker charges a commission. The quoted price that you see, first of all, remember, there's two prices. There's an ask price, the retail price, and the bid price, the wholesale price. The quoted price that you see is simply the best price available. But at any one time, there are dozens of prices quoted as dealers and market makers compete for buy and sell orders. The chosen dealer doesn't necessarily have the best price. Instead of paying $20, you might pay $20.05. So you see, for example, a $7 commission on your confirmation. You don't see the extra $5 or whatever it was, depending on how many shares you bought. Because if you paid an extra 5 cents a share, and now the spreads are very low, but there are billions of transactions a day. This is a disclaimer that used to be included in the trade confirmation email from Scottrade, which was bought by TD Ameritrade, which was then bought by Schwab. Anyway, I grabbed this off of somebody's email. Notice it's all in uppercase. Scottrade Incorporated receives remuneration for directing orders to particular broker-dealers or market centers for execution. Such remuneration is considered compensation to the firm, and the source and amount of any compensation received by the firm in connection with your transaction will be disclosed upon request. What the hell are they saying? First of all, businesses are not stupid, right? They want to tell you something that's really important. They put it all in uppercase because then it looks like it's really important and you really should read it, but it's difficult to read all uppercase. That's why you don't see books printed all in uppercase. The uppercase is used for the heading, for the title. And they use words like remuneration, which is a fancy word for kickback. What's going on? They're routing the trade to a particular exclusive dealer, market maker, right? They mean the same thing. And they're getting a bit of the spread back at them. They're getting a bit of, it's called order flow, payment for order flow. Now doesn't that sound innocuous? Oh, it's order flow. In other words, we're getting a kickback. In Scottrade's defense, at least they prominently disclose this relationship in every confirmation email that you would get. Robinhood, on the other hand, brashly declares that they are not making money using this technique when they most obviously are. at least according to both Investopedia and CNBC, which I consider to be both reliable sources. So you see, folks, you are not getting free trades. You're just not paying a commission. You're paying more when you buy the shares. You're paying less. You're receiving less when you sell the shares. Remember the spread. The ask price is what you pay when you buy. The bid price is what you receive when you sell. The Securities and Exchange Commission on slide 41 says that your broker has a duty to seek the best execution that is reasonably available for its customers' orders. But it's not a guarantee. The Securities and Exchange Commission requires broker-dealers to notify their customers if their orders are not routed for best execution. Typically, this disclosure is on the trade confirmation slip you receive after placing your order, which is what we just saw in the previous slide, right? So check out what Investopedia has to say about it. And determining whether or not a customer got best execution can be very difficult. Here is an example of the Securities and Exchange Commission trying to enforce the rules and not doing a very good job. They lost the case. The Securities and Exchange Commission was looking into making the cost more transparent, possibly showing the customer the difference between the dealer's price and the best price available at the time of the transaction. Maybe even, gasp, showing the total cost of the transaction from the markup or markdown. This did not go over well. Needless to say, the deep discount brokers cried that it would drive up the cost of commissions and ultimately hurt the consumer, and the proposal died. So it's up to you to check if you are getting the best execution, but how can you, a lone investor, determine if you're getting the best price if even the Securities and Exchange Commission has trouble watching over the brokerage companies? They're lawyers, they're professionals, and they have a difficult time. To make it even worse, on slide 43, we've been talking about these broker dealers. We haven't really honed in or dialed in on what they actually are. Folks, they're all computers. They're not people. And they are doing what's called high frequency trading. These systems, you might have heard of Citadel. What's the other big one? Starts with a V, I forget. They use computers to transact large numbers of orders at very fast speeds. Now, I know you guys don't really like books, but I like books. And there's a wonderful book by a gentleman by the name of Michael Lewis. Read anything that he writes, called Flash Boys. Now, unfortunately, it's 10 years out of date, so the technology, I'm sure, has leapfrogged whatever he wrote about 10, 12 years ago. But there is little doubt that high-frequency trading has reduced transaction costs. However, at the same time, these high-frequency trading firms have been accused of using their ability to transact at the microsecond level to front-run investors. In other words, they see your transaction, they jump in front of you, and then raise the price. Buy it before you buy it, raise the price and sell it to you. Essentially, they're stealing teeny amounts of money from the average retail investor and even large players like mutual funds and pension funds. And so, these are big boys and girls with millions of dollars, and they're not happy about this. So one firm, IEX, I forget exactly what it stands for, but is fighting back and has the backing of some very large players like the Texas Pension Fund. And I think it was it T. Rowe Price Capital, which is American funds. And you'll read all about it, the hero of the story who started IEX, in the book Flash Boys. And there's a couple of videos on the website and in Canvas for you to take a look at. What IEX did, because this guy was getting screwed by these HFTs and he was not happy about it. And he was trying to find a way to fight back. And he did. He created a company called IEX that has a speed bump so that the high-frequency trading firms cannot jump in front of you and front-run your transaction. So the Securities and Exchange Commission back in 2016 approve them as an exchange. And there's an article from the LA Times because the Capital Group is one of the largest money managers in the world, and they weren't the only ones. They weren't the only ones who supported IEX in their fight. And now IEX, I think, is about 4% of trading. And if it's only for the big boys and girls, I'm sure they're very happy to be not being screwed by companies like Citadel, who will tell you to your face, "Oh, of course we're not doing this." Now, the problem is it's all, what's the word? Proprietary, right? So they're not going to disclose how they do it. In the book, Michael Lewis will be the first person to tell you that nobody really knows how much money they're skimming off the top of the economy. But the best guesstimates are between $5 and $15 billion a year. And of course, this was 10, 12 years ago. Maybe it's more, maybe it's less, I don't know. But when you think about it, let's split the difference and say $9, $10 billion. Well, remember, our economy is 20-some trillion dollars, and billions of dollars, trillions of dollars transact every day. So $10 billion is about what people bet on the March Madness NCAA basketball tournament. So it's a tiny, to you and me, that's a lot of money, right? But in terms of the economy, oh well. And then what happened is in the early 2010s, there were several documents coming out of the Securities and Exchange Commission to the world and to us brokers, saying that they're looking into HFT, high frequency trading. We want to make sure that the playground, no, not the playground, but it's a level playing ground, and we want to make sure that if these people are doing what they're doing, we don't want them to do it anymore. And then all of a sudden, about 2015, you didn't hear a thing. I think what they did at the Securities and Exchange Commission is they said, look, these folks have reduced transaction costs dramatically. Let's not throw the baby out with the bathwater, as the saying goes. Let's just say, okay, let them do their thing, and we'll see what comes down the pike later on. So if you're so inclined, look into how this is working, because it's really exciting, I think. I haven't followed it as much, but reading Flash Boys was a great joy, and it's a lot better than watching television. Slide number 44. You're going to hear every once in a while, especially from us old folks, that you should only buy 100 shares at a time, or 200 shares, round lots as they're called. Folks, this is an anachronism, another fancy way of saying this is obsolete. Remember the face-to-face trading? Well, round lots made it easier for the folks on the floor to trade shares. If somebody were to yell out 25 and move their hands towards themselves, put their hands out in front and then move the hands towards themselves, what they were saying to the other traders on the floor, the other brokers on the floor, I have a client who wants to buy 100 shares at $25 a share. If they push their hands away from themselves, and I'm moving my hands back and forth, of course you can't see them, but if they took their hands and pushed it away from themselves and said 25, then that meant they have a client who wants to sell 100 shares at $25 a share. If they said 2 at 25, it was 200 shares. 3 at 25, it was 300 shares. You see how that made it easier, facilitated trading? It's all gone, of course, but because you don't have to say 100 shares at 25, you just say 25. Now, what happens when a person wanted to sell 17 or buy 17? That is called an odd lot, less than 100 shares. Then they would have to say 17 shares at 25, and it would slow the transactions down. For that reason, there was what we call an odd lot differential, an extra cost of trading in odd lots or mixed lots. Mixed lot is over 100 shares, 117 or whatever. But that's gone now, folks. It used to be they would charge you an extra 12.5 to 25 cents. 12.5, yeah, it's old. It's old, folks. It's all gone. All that technology has gotten rid of it. And, you know, it used to be maybe 5 cents now or 1 cent. It's just not anything you have to worry about. But as rising investment gurus, you should know, just in case somebody comes along and says, well, you should at least buy 100 shares. You say, no, I don't need to buy 100 shares. I can buy 10, I can buy 17. It doesn't matter. The computer doesn't care. Got it? Okay. Now, how do we get quotes? Well, different sources will contain some, all, or more of these statistics that are here on the left. But always remember that you are not seeing the best price, right? You're not seeing all the prices. You're seeing the best price, and you're seeing it 15 to 20 minutes ago. Unless you have a brokerage firm that you log into and they tell you, yeah, this is what it is right now. But remember, it's changing at breakneck speed, so you can't be sure what exactly it is. And remember that there are dozens of prices at any one time being quoted on what people will sell you the shares for, the ask price, and what people will buy the shares back from you, the bid price. Got it? And so some of these things that we ask you to look at, the dividend yield, the PE ratio, the earnings per share. So some of these things you're going to be looking up in Chapter 3. Okay, so that's reading stock quotes. And some of the other things we'll talk about later on. What is PE? What open, high, low, close? It's not important in my humble opinion. Year-to-date volume. There's some people who look at that, look at the volume, look at the 52-week low and that. But we're going to look at certain pieces of information. Later on, you can decide whether or not these other pieces of information are important to you. And so where do we go? Where do we go? Who do we look at? Well, there are numerous free websites, fewer and fewer than there used to be. And what some of them are doing is using the freemium model. You've heard of the freemium model? For example, Bloomberg and MarketWatch and Morningstar and Yahoo now will give you certain information for free. But they want you to sign up for their premium version. And Morningstar is the worst, right? Every 5 minutes are popping up something. Please sign up, you know. And Yahoo used to be the best free website on the internet, period, folks. It was very, very good. This was, you know, like 12, 15 years ago. And then this woman came along, Melissa Meyer, whatever her name was, and she just destroyed Yahoo, in my humble opinion. It's still useful, and we often use it. Bloomberg, a lot of other brokers tell me they love Bloomberg. I think it's okay. I don't think it's that spectacular. MarketWatch is the free version of the Wall Street Journal. The Wall Street Journal you have to pay for. MarketWatch is actually pretty good. But again, they're now saying, you know, we can't support the site all on just advertising. We got to get people to sign up. Morningstar, if you remember them from Chapter 2, they started out just doing mutual funds. Now they do stocks. And they're okay. You know, I've been using them more and more. Google's finance page is not that great. I like it just because it shows you really easily what's going on in Asia, what's going on in Europe, and the like. But it doesn't give you as much information as the others. Although it's a good place to start if you're going to be researching the company. But one of the best places to start is the company's website. And you're going to be doing that in Chapter 3 as part of your assignment. Now, when we get to Chapter 4, you're going to see a super-powered website called Value Line. But I don't necessarily suggest that you use it in Chapter 3, only because it's going to give you a sip from the fire hose. We'll wait until Chapter 4 for the sip from the fire hose. If you have others that you like, Big Charts, CNBC, who else? I'm blanking. But tell me what you like, what you think is good. And in the face-to-face class, of course, we would stop and take a look at some of them. So online is a quick presentation that shows you, I think I go through Yahoo Finance, Bloomberg, MarketWatch, Morningstar. I don't think I actually look at finance.google.com. But play. And if you have a brokerage account with TD Ameritrade, which is now owned by Schwab or E-Trade or whatever, they have their own systems and give you much more information as part of your brokerage account. Some students have told me they really liked TD Ameritrade's Think or Swim. It's called Think or Swim system. And of course, Schwab bought TD Ameritrade, so probably Schwab is going to be using them. And it's interesting, I always said to myself, well, I can't really open up a Schwab account without really angering my boss, because they're a competitor, right? And also running afoul of the Securities and Exchange Commission. If you're a broker, why are you opening up a brokerage account with another company? What's going on here? Well, when you open up an account, they're going to ask you, do you have any other accounts with any other brokerage companies? And you're going to say, well, why do you care? The reason it goes back to 100 years ago, when brokers and other nefarious individuals would have several accounts, and they would then use these penny stocks that we're going to discuss later on, not to be discussed normally in polite company. They would start buying and selling these penny stocks to themselves and raising the price and making it look like something's hot's going on. Oh, look, this stock used to be 3 cents. Now it's 4 cents. Now it's 6 cents. Now it's 8 cents. I want to jump in. It's going up. Well, because they're buying and selling it to themselves. So you see why they want to know, okay, if you have another account, we're going to make sure you're not buying and selling to yourself and playing this game of pump and dump. Make sense? Yeah, okay. So have fun, and that's part of your assignment is to look up some data. And as we say in the assignment, the information you're getting is nowhere near as important as the experience that you are having. We want you to analyze you analyze your experience, analyze your emotions, analyze your feelings, your thoughts. Am I enjoying this? Does this pique my interest? Do I enjoy looking up this information and looking at the competitors and their suppliers and their industry as a whole and their customers? What are they doing? What's going on? Because this is what investing is all about, in my humble opinion. Not reading squiggles on a screen and deciding whether we're going to buy and sell tomorrow before lunch. That's my humble opinion, and I'm sticking with it. Make sense? I hope so. In our next presentation, we will finally, where are we in the semester, right? We will finally introduce and define and look into the details of stock market indices, stock market averages, benchmarks. Standard & Poor's 500, Dow Jones Industrial Average, NASDAQ. Yeah, finally. We've been using them since the beginning of the semester, and we finally get to identify them and look into the details of these. So make sure you understand the transactions and the costs involved. Make sure you understand what a round lot and an odd lot and a mixed lot is and why you don't care about them anymore. But if somebody does, you're going to dissuade them from worrying about buying 100 shares. And then go have fun reading stock quotes and doing the first assignment for Chapter 3. Thank you, dear students, for being in our class. We are all of us at Southwestern, so grateful and honored and happy that you're with us. See you in our next presentation.